Incentive stock options, also called ISOs, can be complex and confusing, so let's hit on a basic hypothetical example to illustrate how they can work. So where we want to begin is with these three key points. There's the grant, the exercise, and the sale. So a company grants you the options, and then you have the ability to, in the future, exercise them and then sell them. So there's going to be a date where the company grants you X number of ISOs at a specific exercise price, also called the strike price. So let's say in this example, they grant you 1,000 ISOs with a strike price of $10. From here, you're likely just going to wait a while because there's probably a vesting schedule in place, which simply refers to a point in time where you're then able to take action and exercise the options that were granted to you. So let's say you decide to exercise here when your company stock is currently trading at $30 per share. So what you're actually doing when you exercise is you're taking those 1,000 options at $10 an option, paying $10,000 to then own 1,000 shares of your company stock. So you're paying $10,000 to buy something that is currently worth $30,000, and that's a pretty sweet deal. So now you've exercised your options, and now you have actual shares of stock. And in this example, you have a gain of $20,000. So the first thing you can choose to do is immediately sell after exercising. And some people might decide to do this to lock in their profit. So if you decide to immediately sell, from a tax perspective, what that means is you're going to pay ordinary income tax on that profit. So whatever your marginal income tax rate is what you'll end up paying. And let's just say you're a high income earner with a marginal tax rate of 32%. There's another option, and that is to not immediately sell and to hold the stock and sell at some point in the future. And let's say you do just that and you're in a good position. The stock price continues to increase. We're now at $35 a share, and this is when you sell. This is where it's really important to understand the advantageous waiting period for ISOs to potentially pay a much lower rate on the gain. So what this could mean for you from a tax perspective is if you satisfy that waiting period, you could be paying long-term capital gains tax rates on that profit instead of the, generally speaking, much higher ordinary income tax rates. That could be the difference between 15% or 32%. And maybe the stock price doesn't continue to increase and instead you sell here at $30 a share. You can still qualify for that lower long-term capital gains tax rate, 15% for most people, instead of that 32% if you satisfy the waiting period. So what is that waiting period? So there are two parts to this waiting or holding period requirement. And the first part is before selling, you need to wait more than 1 year from the date of exercise. In addition, you need to wait more than 2 years from the grant date. This gives you the opportunity to take advantage of the more favorable, lower long-term capital gains tax rates. But there is something that you absolutely need to be made aware of. It's called AMT, which stands for the Alternative Minimum Tax. So AMT comes into play when you exercise your incentive stock options and you have a gain, but you don't sell in that same calendar year. Basically, what this means is you may owe tax on this gain, even though you haven't sold yet, even though you haven't realized that money yet. So this could be a sticker shock come tax time. But the good news is, generally speaking, you are able to recoup that in the form of AMT credits in future tax years. To shed a little light on AMT, AMT builds up in parallel to your regular tax liability. So you pay either the AMT or your regular tax bill, whichever is higher. Most years, for most people, your regular tax is higher than the AMT, so you don't need to pay the AMT, and most people don't even know it exists. But the phantom profit that comes from exercising ISOs and not selling in that calendar year counts towards your AMT, but it doesn't count towards your regular tax, and this is what can tip the scale.